What do you think as we head into the last month of the year?
Well, I think the market is okay until the end of the year. People complain that the market is overvalued, but in my dividend discount model, at these interest rates, the market is at fair value, really below fair value. Still has some room to move up.
Below fair value being what? Where are we right now? We're at least 19 times, aren't we?
Well, 18 times next year's earnings. But at these interest rates, that's not an excessive valuation. This is nothing like 2006 or 1999.
And so does it end up still being about rates and your view of rates at this point in terms of your overall market prognostication?
It's about rates and earnings and a China trade deal. But rates are attractive. Earnings are still coming through. It looks like 2020 is going to be a 2% year at least. The last revision of U.S. GDP was up. So we're in a pretty good situation domestically. Around the world, there's plenty to worry about. But the U.S. seems to be plowing through the adversity.
Yeah, well, you do sound fairly positive. One thing that we've talked to you about in the past, of course, is the impact of what had been an impasse on trade with China, what had been a worsening situation, but now appears to be moving towards perhaps a resolution. Does the market already have that priced in, Byron?
Yeah, I think so. It has the low-level resolution. Trading, they'll buy soybeans and pork, and we won't raise tariffs on December 15th. But that's not the broad plan, which would involve intellectual property, joint ventures, and the access to their markets for our financial institutions. That would be the big deal, and that's still a way off.
So, Byron, if not for the trade war, what do you think is keeping the market depressed below its fair value right now?
What's keeping it below fair value? I think there's a lot of skepticism out here. With the performance of the market this year, you would have expected there'd be some euphoria. But the market doesn't exhibit euphoria, at least the way I look at it. People are still pulling their money out of equity mutual funds. You don't see hedge funds enormously overexposed. There's plenty of skepticism about the market. We've been in a bull market for more than 10 years now. And people think it can't go on forever, and they're right, it can't go on forever, but it can go on a while longer.
Byron, a lot of people look at the rally of the last few weeks and look at how it's coincided with the re-expansion of the Fed's balance sheet. Goldman says that the gains for the year probably would not even be here if it hadn't been for central bank support. Do you lean into that? Do you agree that we owe most of this year to the central banks?
I believe the whole move of the market since 2008 is a result of monetary easing, not only in the U.S., but around the world. The balance sheets of the Federal Reserve, the Bank of England, the European Central Bank, and the Bank of Japan were $3 trillion in 2008. They're $16 trillion today. This market has been fueled by enormous amounts of liquidity, and when that liquidity stops, then you can start to worry. But the liquidity has not stopped yet.
Did you just say a decade's worth of gains are thanks to central bank support?
Yeah, I'm saying that the market is that the most important factor influencing the market is central bank liquidity.
And there's no sign in your mind that that's going to reverse?
I don't think it'll reverse. It may go from plus to zero. I expect that'll happen, but it isn't happening yet.
Byron.
Yeah, nobody seems concerned about budget deficits or things of that nature here as well at this point, Byron, despite the fact that we're running record deficits, at least certainly given what are good economic times.
Right, absolutely. You would expect the deficit to be coming down, but it's $1 trillion. Here's something else that'll worry you for the weekend. The balance sheet, or the accumulated debt of the United States in the year 2000, when George W. Bush became president, was $6 trillion. The debt today is $22 trillion. It's gone up almost 4 times in less than 20 years. The blended interest rate in 2000 was 6%. Debt service was $360 billion. Today, the blended interest rate is a little over 2. Debt service is $450 billion. So the debt is almost quadrupled, but the debt service has only gone up 25%. That has never happened before in economic history.
Fascinating. And, of course, gives you pause as to what would actually happen if rates were to move up appreciably. It's almost as though it can't be allowed to happen. It would swamp the entire budget.
Right. Every 1% is $220 billion. You know.
Yeah. Yeah.
So, I mean, there's plenty to worry about, but but the worries won't kick in for a while.